topic would like to see where the position for Nifty and Bank Nifty is and what we should do. Now we'll go to the chart, tradingview.com. You can see this particular level of support. Now this is the 0.785% retracement Fibonacci. We are just only using Fibonacci here. This is 0.785 of this entire move from 17,600 to 17,842. So this is the retracement level, and if this is going to fall, cut this level, which is 17,653, right? So if it is going to cut 17,653, then in that case, you can go for a short and then put in a stop loss at 78.5% retracement from this level to wherever it goes down, right? So the initial thing will be 17,653, and then you can put in a stop loss probably at this level. Initial level will be 17,779, and then you can keep moving it down from this level to wherever it goes down. Okay. So generally speaking, the one strategy that you can adopt, which we'll come back to after some time, is that on an intraday, if this day is like this, then next day it may come retracement to 78.5% retracement. If it's going to cut below this, then probably we can put in a stop loss. This is a general move. Now if this is going to be a bearish day, let us say this is a bearish day, and then next day it rallies, then we can wait for the 78.5% retracement. Okay, so if it's going to cut 78.5% retracement, then probably we are looking towards a bullish sign. So based on this, I think the entire move was like this. That is the this was the from this day for this this level was the entry point, a cut above this. So that's why we saw the market zooming on this particular hour itself. So above 17,750, that was a stop loss, and that got triggered, and you can see a big move to 17,852. And if you had gone long above 17,750, I think the stop loss is now coming at 17,653. Now Bank Nifty, we'll look at Bank Nifty also. So Bank Nifty for this from here 78.5% retracement was this, right? So it did have a cut above this particular level. So it moved above this level. So which means the stop loss now is going to be stop loss is going to be from this level. You can put it from this level, because this 0.785% is cut here, so we can put it for this level. So the stop loss will now come closer to this level. That is a cut below 37,459, 549. It does not cut that level. So if it cuts that, then probably we will go for a stop loss in this case. So Bank Nifty right now, based on the daily, this one, I think we need to wait and see how it reacts. And Nifty, if it cuts today's low, then we are going short. Nifty, if it is going to go below today's low, then we are going to go for a short. Now, so we will turn back to our topic of the day, which is the trading with small capital. Now that day we illustrated the replacement for futures. Now futures, you require huge amount of cash outlay, and in the case of Nifty futures itself, you may need something more than 1.25 lakhs for one contract. Now this, if you remember, we replaced it with deep in the money option, deep in the money call. Suppose we are going to go long, we decided that we will replace this with a deep in the money call, deep in the money call option. And probably even at a 500 points down level, at a 500 points or 300 points from the entry price. Suppose if you feel that you are long at 17,600, then in that case you can go for a 17,100 weekly option on a call option, or 17,300 weekly call option. Now that will give you 500 rupees into 550 is 25,000 rupees only. So the outlay in this particular case, in the deep in the money call option, is only going to be 25,000 rupees. So as against 1.25 lakhs in futures, so definitely you can reduce your capital, and also to some extent you are able to reduce your risk, but you get a payoff profile which is very similar to the futures. So this is what we have highlighted before. And we also said that the second alternative thing that we need to go is for a spread option. Now we will illustrate some more basics of option. Then what is a spread option? Then in that case, how do we use this spread option effectively in order to reduce the capital that may be required for a cash market investment? So spread option, we said very in last session that we need two legs. So any spread option, when we mean we need two legs, that is, one is a buy leg and another is a sell leg. Buy leg, sell leg. And you may be aware that the sell leg always, if it is a edged contract in NSE, then the sell leg carries only an exposure margin which is 2%. In the case of index, and probably 3 or 3.5, we have to check. Let us say 3% or 3.5% in case of stocks. 3.5% in case of stocks, as far as the exposure margin is concerned. Then we have to pay the premium for this contract. If there is a premium to be paid, we need to pay the premium. If there is a premium to be received, it may be debited from the margin that we are paying there. So we have to look towards how effectively we need to reduce our capital and get ourselves something very similar to the quantity that we want, because each one's appetite will be different. Now in the case of, say for example, say Reliance may have a futures contract of 500 units, okay, 500 quantity. Forget about the futures minimum contract. Let us say you want to only do say for example 20 units of Reliance or 50 units of Reliance. Okay. In the case of index, you don't want to do for 50 units. You just want to do only for 20. You just want to for 20 quantity. In that case, the alternative to that will come as a out of the money call option. Out of the money call option can have some characteristic which is equivalent to a 20 unit of a Nifty. Now, how do we say all these things? Okay, for which we need to understand certain parameters in options. That is what they call as option Greeks. So I will not get too much into the technicalities, but certain things which you must know, because we have to invest a little bit for gaining knowledge, so that that knowledge can replace the capital. Okay. So let us say the options, we have already highlighted to you that there are certain characteristics of an option which is based on time decay. Then we have the volatility. Okay. Then we have got what we call as a delta. So this understanding of this is very important to structure options in a spread option to get a quantity of size of what we want. Now this delta is nothing but the probability. That is nothing but the probability of the price exceeding a particular strike price. Now let us say I am at 17,600. Let us say this month end option, which is on 27th of April. If I am at 17,600 and I am doing a 17,600 strike, then it's symmetrical, right? So the chances of the price being above 17,600 on 27th of April and below 17,600, as per the formulas, it will be 50-50. Statistically, it could be different because normally the price keeps exceeding. So I think probably the chances could be 55-45 or so. But normally this pricing is done at 50-50. So the chances that it could be above 17,600 could be 50%, and the chances that it could be below 17,600 could also be 50%. So that means the delta, which they call the chance, when we saw the terminology that we use, there's a chance or a probability, is nothing but the delta. is nothing but the delta. So the delta then in that case it becomes 50%. So the chances that the market could be above 17,600, if the price today is 17,600, the chance that it could be above 17,600 on 27th April is 50%, and the chance that it can be below 17,600 is also 50%. So this is called delta. So this could be different for different strikes. Now when I say 17,600 is 50, so you may ask, what if it is 17,800? What if it is 17,800? What is the chance? Similarly, if it is 17,200, what is the probability of the price being above 17,200 on 27th of April? So this is all based on at that point of time. That is today if I am doing it, and if I am at 17,600, what is the chance that price will be above 17,800? But tomorrow the price itself jumps to 17,800. Okay, then what is the chance of that could be above 17,800 on 27th April? It will say 50-50, because normally, in this we have what we call statistically we have a bell curve. So if it is exactly at the same price, it will say it is 50-50. But those who have already worked in the market may know that since the price one day before was 17,600, that time the probability of it exceeding 17,800 is only slightly less than 50%, and now it has jumped to 50% because it has the price has come to 17,800. So that may be a question. So that we need to work it out very mathematically, statistically. We have to find out all those things, then come to certain sort of conclusion on all those things. But what we are saying is that if it is already at 17,000, if it is at the same strike, then chance it could be 50-50. So similarly, we can find out the delta of 17,800 when the price is at 17,600. So this understanding is very much required in order to ensure that we put in a spread option to get the quantity that we want. So let me give that with a clear illustration now. So let us say we are at 17,600. Okay, just under the price could be different, but I'm just saying 17,600. Now 17,800, okay, and I will take 17,400. I will take these two, okay, and I'm going to buy a call option. I told you very clearly that a spread is buy one strike and sell another strike, which is a higher strike price. So I'm buying a lower strike price, which is 17,400 call, and I'm selling a higher strike price, which is 17,800. 17,800. So the difference is 400 rupees, and I'm exactly at 17,600. So what is it that what can happen? Now suppose what I'm interested is, if the price moves by 100 rupees, if the price moves by 100 rupees, I want my profit to move by 2,000 rupees. That's what that means. You want to hold 20 units of the quantity. That means you are now fixing yourself that the amount of investment that you are going to do in the cash market is for 20 shares. Let us say you're going to do it only for 20 shares. So 20 shares, when you do a Nifty in today's price range, it's going to be 17,600 into 20, which is going to be 3.5 lakhs plus. So what I want is, I want this 20 unit, okay, in Nifty, but I don't want to pay 3.5 lakhs. I don't want to pay 3.5 lakhs. What do I do? Okay, so this is equivalent in the cash market. What we will do now? I am giving a proposition that you buy a 17,400 call and you sell a 17,800 call, and I am at 17,600. This is for date at 27/4. So what I want to know is that tomorrow, if I bought this 20 shares, tomorrow if the price moves by 100 rupees, I'm going to get 2,000 rupees. If the price is going to fall by 100 rupees down, I'm going to lose 2,000 rupees. Similar thing I wanted in this option, but I don't want to pay 3.5 lakhs. So tell me, what is the capital I should invest for the same amount of profile, that is risk reward profile, for which we have to take one option price calculator. So if you Google it and say option price calculator, you will get various calculators you will get. So you can choose one amongst them. So I will illustrate to you now. How do we know how to construct this? So we have what is called, this is in a white background. I'm unable to help you out because this is not our background. This is what the website is, but I will read it out for you. Now this is optionprice.com. This is one of the sites. You can use any other sites also. So the site is optionprice.com. Okay, there I'm going and I'm going to punch in certain data and get some output. Now underlying price now is 17,600, right? I'm going to price, underlying price is 17,600. I told you I'm going to take two strikes. One strike that I'm taking is 17,400. Now days to expire, today is 11th, so 27th is 16 days to expire. 16 days to expire. Now the 17,600 is a futures rate. I'm keeping it as a futures rate, not a spot rate. So that means interest rate I'll put as 0. All other parameters I'll put at 0. And the volatility will, because I'm going to go to a spread option, these things are not going to make any difference for me. But let me say I'm putting it as 20% for understanding purposes. So now I'm calculating it. So the price, this is not a reflection of any particular price at this point of time. So I'm just only giving you an illustration. And I'm also, because we are going to do a spread option, certain things will cancel, so it will not matter. So what's important is 17,400 if I, strike price if I do, then the price is around 403 rupees and the delta is 0.61. So I'm more interested to know about the delta. So 17,000 with this futures price is 17,600, 17,400 call option, the price is 403, the delta is 0.61. So what this delta of 0.61 means, suppose I'm just buying a 17,400 call. If the delta is 0.61, tomorrow it moves by say 200 rupees. It moves by 200 rupees. Then my call option will move by 200 rupees into 0.61 because I am holding 61 units equivalent. I am holding into 61 units, or that is, I would say 61.61. If 100 rupees it moves up, then in that case I am going to hold something like 120 rupees I am going to get here. I am going to get 120 rupees because I am holding a delta which is equivalent to 0.61. So for a 200 rupees movement, I will get 120 rupees. So what I will do is, suppose if I want to hold 60 shares, if I want to hold 60 shares of this one, Nifty, okay, now 60 shares of Nifty, then in that case what I will do is that I will buy 17,400 call option because I want to get something which is similar to the cash market. Okay, so if I hold 60 shares of cash market share, tomorrow if the price is going to go up by 200 rupees, I'll get 200 into 60, right? So I will get 1,200 200 into 60 shares, right? So I will get 12,000 rupees, right? So what I want is something which is very, very similar to that. Okay, so tomorrow let us say the price this also moves up. Okay, so in this case I'm holding a 0.61 delta, 0.61 delta. So if the price moves by 200 rupees, okay, so that will also move by 120 rupees. That will move by 120 rupees. Okay, now what I want is that this is 12,000 rupees. Okay, now this is 120, but I am holding only in terms of the minimum contract lot size, right? So when I am holding a 50 shares of that is Nifty, because that is a Nifty call option. Nifty call option size is 50. So if I am holding a delta of 0.61, the price would have moved from 403 to 523. So I am getting a 120 rupees profit. But 120 rupees profit is on 50 units, which is 6,000 rupees. Which is 6,000 rupees. So that means here it is equivalent to 30 shares. Right? It is equivalent to 30 shares. So now what I want to do is that I want to do something similar to that, but I am not here doing for 30 shares. I'm doing it. So if I want, I can take this 17,400 call option and do the deal. But I want a quantity which probably can reflect even slightly lower, which may not be possible sometimes. So in that case, I will go for a spread contract, mainly because to avoid certain pitfalls. One is, in the case of this call option, let us say it stagnates. Then I told you I'm losing a lot of things on time value. Okay, so the option characteristic is such that if you buy a plain option, you will lose a lot of things on either the volatility change or the time decay, all those things. So I want to remove all those things. I just want to be able to in a normal one. Okay, so I'm going for a call option, which I told you, and I will remove this. So 17,400 call option, I'm buying it at a 61 delta. Okay. Now let us say 17,800. What is the delta for this? Exercise price, I'm changing 17,800. Okay, volatility will be slightly, there's a skew in that, so I'll put a slightly lower volatility for out of the money option. So the price is 192, delta is approximately 40. So here the price is approximately 40 delta, and price is 193. So this is 403, this is 190. Okay, so the difference is something like 213 rupees. So I'm exactly at the middle, 17,600. So I'm paying a premium which is 213 rupees net, and I'm getting a delta which is 21. So what does this indicate? This indicates that for an 100 rupees price movement, I will get a 21 rupees upside movement. So if I buy at 21 shares, normally what will happen is, if I buy at 21 shares, I will get a price. If the price moves by 100 rupees from this place, then I will get 21 into 100 is 2,100 rupees, right? So in a cash market, if I invest 21 shares, then into 100, 2,100 rupees is what I will get. If I have to invest 21 shares, today I have to pay 3.5 lakhs. 3.5 lakhs I have to pay. Now here, if it moves up, the same thing, if it moves up, here the price, delta price, 61 minus 40 is 21. So for an 100 rupees movement, I will also get 21 rupees in the change in the option price in my favor. So 21 into, if I hold 1 unit of this, then I will get 50. Okay. So I need to have 2 units of this in order to get the 2,100 rupees, right? So I need to find out the funds for a spread option of this size for 2 units of Nifty contract. So I told you that in a spread option, you have to pay the premium, net premium. Pay net premium. Then you pay, it is an index, so 2% exposure margin. So 2% exposure margin now on a 50,000 into 17 is around 8,50,000. So approximately 17,000 rupees. 17,000 rupees. And I told you the premium is 213. So 213 into 50. So approximately, let me say, is 10,000 rupees approximately. So I'm getting 27,000. Now I need to have 2 units of this, right? Because in order to get that, so this is 54,000 rupees. So this is 54,000 rupees. Now I will have a cash market transaction. If I do that, then the cash market transaction, I need to pay 3.5 lakhs. But whereas in this case, it is 55,000. So it's only 15% approximately of the cash market that you require, but you are in a position to get in a same profile, okay, similar to the cash market investment. So if tomorrow the change is going to be there, up by 100 rupees, whatever profit that you will get in the cash market, you will get the same option in Nifty for an investment of only 55,000, whereas there you have to pay 3.5 lakhs. Okay, so I will not been able to reduce the this one, that is the investment? Have we not been able to reduce the investment? Now, the same thing, now if you're 2,100 rupees, you got it. So if you do for under this one, so you will get, in the case of a futures, you may get 5,000 rupees. So here you have to do some 2.5 units, approximately 2 or 2.5. You have to go, this we have done for 2,100. So we may have to do another two times. So that means approximately this 55,000 rupees will become the same 1,10,000, which is equivalent to the futures margin. So behaves something exactly similar to the futures is the spread option in terms of funding. Okay. But in the case of a cash market, against a cash market investment, in the case of futures, if you buy, then you need to buy 50 shares. Straight away, you need to buy 50 shares for 1.25 lakhs. Okay, for 1.25 or for whatever amount that is there. But if you want to buy for a lower quantity, you cannot buy, because minimum size is only 50 units. But whereas we have shown that we can go for a slightly lower quantity also. Much lower quantity also you can do. So if you want a quantity which is lower than the minimum contract size which is mentioned in the case of your futures, then in that case you need to look at the spread option like this, in order to ensure that whatever the disadvantages of options are removed, and you are in a position to reduce your cash market investment, right? So very, very important for those who are doing cash market investment to consider what is the better. So whenever you are making an investment, okay, I'm not saying that you should do everything like this, but I'm only saying that if you are investing 10 lakhs in mutual funds and all, I'm not saying that you should not do that. But just think about this, okay. One small investment, instead of 20 shares, putting it for 3.5 lakhs there. Try this for a 20 units of this. Okay, so there is no harm that is will be there. So at some lower level, let us say you want to do some sort of a SIP type of scheme. You can even reduce this and keep doing like an SIP also at some lower level. I will illustrate to you now. We have done for the 200 rupees gap. Okay, for 200 rupees gap we have done. So if you do it for only 100 rupees gap, now I showed you that. Okay, now if you do it for 17,500 to 17,700, let us say you do it, probably you will get it for 0.1. The delta will be differences 0.1. So for every 100 rupees price movement, you will get 10 rupees there. Okay, so for 100 shares, normally if you do, okay, or let us say you want to do for say 20 shares, okay, and 20 shares you would like to do this one delta. So for 100 rupees movement, for 20 shares you will get 2,000 rupees. For 2,000 rupees. Here you got a delta of 10. That means for every 100 rupees movement, you will get 10 rupees into 50. So you will get 500 rupees. You will get 500 rupees. So what is this 500 rupees will represent for an 100 rupees movement in cash market? It is going to be, say, let us say 5 rupees for an 100 share, right? So it is going to be, I'm going to get for a spread option between 17,500 and 17,700 with a net delta of 0.10 for an 100 rupees price movement, I will get 500 rupees as the profit. Okay, I will get only 500 rupees as profit because the movement is 0.10 and I'm going to get 10 rupees in this one and 50 shares is there. So I'm going to get 500 rupees profit. Okay, so if it is going to be 500 thing, and if I'm going to make for a 100 rupees movement, I've already told you. So in that particular case, in a cash market, if I'm investing 100 shares, okay, so for a 100 rupees movement, okay, then I will have to invest something like 5 shares. Okay, so it's going to give me 500. So there I'm going to get 85,000 rupees. 85,000 rupees. Here I'm going to invest, this is nothing, not much of this one, so 100 maybe 17,000, so maybe 22,000 rupees. So still the investment here is going to be much lower. So depending on how you want to reduce your cash market investment, you can adjust your spread accordingly. So better now you go for something of a slightly higher spread in the sense that now I gave an illustration of 200 points. Probably it is better to go for some 300 points difference, so that your investment when compared to the cash market here in this case will look much lower. Okay, so better to go for a spread which is, in the case of a Nifty index, better to go for a 200 point spread. Sorry, the spread should be 400 points, but you are in the middle of the contract, 17,400, 17,800. Okay, so you can just decide whether you want to go for 17,400 to 17,800, or probably you would like to do for a 17,300, 17,900 or so. Because here in this particular case you will have a 300 rupees premium, approximately 15,000, and 17,000 here you will pay, so 32,000 or so will be the investment here, but you will get a much higher delta, and which will be equivalent to something like a 4 lakh 50,000 rupees investment, or even 5 lakh investment in a cash market. So accordingly, you can plan your script movement. Okay, you can plan. So instead of a 5 lakh cash market investment, so you can go for this. So similarly, you want to do this 5 lakhs in a very split manner. Let us say, you would like to do 1 lakh, 1 lakh, 1 lakh, 1 lakh at various levels. So accordingly also you can keep reducing your spread size or increase your spread size according to what exactly you want. Okay, according to what you want. So this is the way normally you can adjust your spreads. You can adjust your quantities. Okay, and you can get, now I've given you a spread which is almost we are in the middle of the contract, so we are doing that. Okay, so it looked as if that is we have to do between 17,400 and 800 if you are at 17,600. It not necessarily. So you can be you can also do contracts like this. If you are at 17,600, probably you can even think of 17,400, 17,700 spread. So you can just see what this delta is and how this delta is going to match what you want. So accordingly the size, this could be something like a 0.61 delta which I told you. So this could be 0.41 instead of 0.41, it could be 0.42 or something like that. So it could be even probably 45 or so. It could be 45 or so. So probably you will have much lower movement that may be there. Okay, so accordingly probably you can reduce your investment because you are getting some premium for 17,700 more than 17,800. So probably you will be able to reduce this. So based on all these parameters, you can look towards how basically you would like to arrange your quantity and arrange the spread strikes. So innovatively you can keep developing your thought process on how exactly you can reduce a cash market investment, and for that what is the quantity of spread that you want to put, and what are the spread strikes that you can adjust. So this is the most important knowledge or resource that you definitely need to gain in order to reduce your capital investment. And once you do this, then at some level you start doing it. Then if the market slides down, then in that case you keep adding on a little more as an SIP. Now, having said that, is this going to give the same profile if the market moves? So that's the second question. So the first one which we have addressed right now is understand delta. Okay, then what is the spread strikes that you should put? What is the quantity? These things are very important. Now we will come to the next stage. That is, market is not going to be static. It is going to go either up or down. So based on the movement in that, we need to adjust our option strike. So that is very, very important. Okay. Now, let us say we started at 17,600. Okay. Now, let's say the price keeps falling and it comes to 17,000. Okay. So in the cash market investment, you would have done in the same illustration which we had, 600 units into 20, so you would have lost 12,000 rupees, right? 600 and 20 units, so you would have lost 12,000 rupees there. Now, when you come to this particular place, we would have paid something like, as I illustrated to you there, we would have paid some 210 rupees. 210 rupees. And we would have had two contracts, right? Two contracts. Margin money we will leave it there, but the premium amount that we may lose. So here, 50 into 2, because we would have two contracts in order to get the same, this one. So here if you lose 21,000 by keeping yourself passive. Suppose if you do that, then in that case you will lose. So what you need to do is, you need to, if the market is climbing up, then it's fine, because in the climbing market you will definitely, we will come to that little later on. So if it is a falling market, okay, if it is a falling market, from 17,600 it keeps sliding down to 17,500, 400, 300 and all. So let us say it comes to 17,300. Then in that case also 17,300 you would have lost only 300 rupees there. In 300 into 20, 6,000 rupees you would have lost. But whereas here you would have lost much higher amount you would have lost. So we should not give room for that. So what we should do is that we should always be in a position to get back this 210 rupees premium that we are paying. So we should ensure that we get the 210 rupees premium. Only thing is that we should only suffer a loss of the same amount. So for every 100 rupees point, we should keep falling by 2,000 rupees in the case of a cash market. Similarly, here also we should have the same this one. Okay. So for every 100 rupees fall or 200 rupees fall, you keep rolling over the strikes to lower level. You keep rolling over the strikes at a lower level. So what you should do here is that typically, if the market slides down to from 17,600 to say 17,400, every 100 points you don't need adjustment, but probably for every 200 points you may need an adjustment. Okay, you may need an adjustment. So from 17,600 you are bringing it down to 17,400. Then in that case automatically you should adjust your price from the same strike price, which was earlier 17,400 to 800. We should now move towards 17,000. Now it's at 17,400. So we should move ourselves to 17,200 to 17,600 for the same illustrations. That is, for every 200 points fall, okay, or 100 points, 200 points, for every, don't keep it more than 200 points. So for every 200 points fall, what you're doing in the case of Nifty is, you are rolling down the strike, same strikes, this one, you're taking the loss, but you're rolling over the options. You're rolling over the option, so that at any point of time, you are maintaining that premium amount which is there with you. Okay, so that is very, very important, that for every this one you should now keep rolling it over and maintain this particular position. Maintain this particular position. Okay, so the premium amount, that is of whatever loss that is there in the premium amount that we have paid should always be there, but the MTM loss alone, we keep on bearing that MTM loss. So let us say the market comes down to some level which is 17,000, it comes to 17,400, and then you are settled down between 17,200 to 17,600. Okay, so then it starts climbing up from there. Okay, then either you can move it upside, or to some extent you can leave also passively. Why is that? The same illustration here of what we said about the loss side. Let us say you have done the trade at 17,600 here. So it moves to 18,100 by the month end. Now here you would have a profit which is 500 rupees in cash market into 20 is going to be 10,000. Okay, 500 points. Here also what's going to happen is you did a 17,400 and 17,800. So you have a profit which is 400, and approximately, let us say for time being we'll take it as 200 rupees you paid a premium. So you will get 200 rupees into 50, 10,000 rupees. 10,000 rupees in one contract. In two contracts you will get 20k. You will get 20k. Right? So what is the advantage of this? Let's see, if you see, most of the time the Nifty will keep moving up. The Nifty will keep moving up, right? So at some stage it will move up. So what you basically need to do is, when it comes down, you do the rollover. When it goes up to a very considerable amount, probably you can be a little bit relaxed. So it will take care of itself. It will take care of itself. So we don't need to bother about it. So only thing that we need to do is that whenever it comes down, now we just need to roll over the option at the lower level. Okay, so that we should keep doing it, and normally we should attempt this in a monthly option and roll it over before 1 week before the monthly option, because in the case of weekly option there is a chance that probably suppose on the last one day, if the fall is vertical down 400-500 points, we may not be able to adjust or do anything about it. So to that extent, we need to be careful about it, about the weekly option in this case, because anyway the margin that you're going to pay, the net premium that you're going to pay and all is going to be the same. There's not going to be any difference. So in that case, it is better you go for the most liquid monthly option and just keep rolling over this particular option whenever you get some 200 points or so lower. In that case, you keep rolling down the option. If it starts going up to a very large extent, you can ignore, because in a month how much Nifty will go by 1,000 points or so, generally speaking. So for up to 1,000 points, I think you are safeguarded here. So you can just leave it there. Only in the case of a downward movement, okay, so you will have particularly if it starts moving below the lower strike level, you will have a greater loss in this compared to the normal this one, that is the cash market investment. So we need to be a little more careful about the downfall, and probably in the upside you can be a little bit relaxed. So we should understand that every downward move we should roll over. Upward move, I think probably you can just be a little bit relaxed. Okay, so this again if you practice, if you understand what is delta, how to use this, what is the quantity that we will do in cash market. So instead of that, can we structure it and put it in the case of an option, whether we should go for deep in the money option or whether we should go for a spread option to do that. I think those things will give you a very good indication. I mean, like what I would say, a greater amount of profit or return on investment, and for a very lower capital. We have illustrated to you the capital that you may require. It's not 3.5 or 5 lakhs. You may need only 35,000 or 50,000 rupees. So you can make an attempt and keep just trying a rollover at lower level. Okay, and higher level you can be a little bit relaxed. So you can make an attempt and try. So this is not an easy subject to understand. So this requires more and more in-depth attention, and we thought we should highlight to you. So those who are interested probably would learn more and try to adopt this in their strategy. So in case you have any questions, please ask. Thank you. Nifty tomorrow level. Okay. So today we had this movement between 17,780, 17,650, right? So 17,780, low is 17,650, close is 17,679, right? So you can see, no, mostly it's a bearish close. So 18. So the average level approximately 17,703. So first of all, we have to see whether it's able to break this. Okay. Then R1 minus 17,650, 17,755. I think this will be a very crucial level, and S1, S2 is possible in case if the market is quite bearish. So 17,703 into 2 minus 17,780. S1 is 17,626. So this could be the first level of support. And if this is going to be broken, then we have 130 points from the average. So 17,703 minus 130. So it can go down to 17,560 levels, right? Which is possible. So if it breaks today's low, this is 17,650 levels is broken, we'll have something at 17,625, but that may break, and this level can offer a good support. 17,560 can offer a support. So we are looking at tomorrow's range between 17,750 to 17,560. So this is the range that we are expecting. Now alternately, you can look at since today it is closed at it's a bearish close. At least it has to break 78.5% of today's high to low, and that is 130 points into 0.235. So 130 into 0.235 is 30 points, which is 17,750. So it has to break this. It has to break this before we get some sort of a conviction in the market. I think the easiest thing is that you can use your Fibonacci levels itself. That is, if a day's high is if it is having a bearish close, then it should break at least 78.5% of that for it to establish a new bullish trend. So tomorrow we will have resistance 17,755. Only if it starts breaking above that, then probably we can look towards going on the long side. So if it breaks 17,650, then I think on a rally you can definitely go for a sell. On a rally you can go for a sell, because I told you that two important points of trend points we must identify. Now that is going to be the last important high and low. That is going to be the last important high low. Now 17,600 and 17,840 I low to high. In that 78.5% retracement, 17,650. If that is going to be broken, then in that case we should now keep from 17,840 to whatever lower levels that we are getting, that we should keep, okay, first. But as it keeps moving down, then in that case we can have the daily basis, that is the daily high low. If that break, if 78% of that is broken, then we can expect some sort of a support. So you can keep one formula that is consistent. If it breaks 78.5% retracement of the high to low of the previous day, then in that case you go long, keeping 78.5% of that previous day low as a stop loss. Okay, so going by that, I think 17,625, if it is going to be broken, then we can keep 17,755 as a stop loss and move the trade. Okay, thank you. Okay, now the rollover is this month 27th. Okay, now let us say 17,600 we have done. Let us say we are at 17, forget about 17,650 or something. Let us say 17,600 we are, and we have done 17,000 17,400, 17,800 call option spread. Call option spread we have done. Okay. Then what we can do in this case is that if it comes down by, we are doing it for 27th April. Okay. Now why we are doing the spread, first of all, is that we are trying to remove any negative effect of a buying call option, because there you have the volatility factor, the time decay, all those things. So that is negated by 17,800. So we want to make it as something very similar to what the futures will be. Okay, but with a lower cash investment. Now, if it moves down by 200 points, if it now moves down by 200 points, then in that case we will move this also from 17,400. Then we sell this 17,000. Now this is a buy option, this is a sell option, right? So what we will do is that we will sell it off this, we will buy this. Okay, so we will have a loss. How much of loss? 200 points, right? So 200, the delta that we saw is 0.20. So for one contract of each of this, okay, so you will have 40 rupees into 50, because one contract. So we will have 2,000 rupees loss, let us say. 2,000 rupees loss we will have. Now, because 200 points movement there. We will now move it down to, we will now, having done this, we will now go for a buying of a new, because it has moved down to 17,400 now. Now it has moved down to 17,400. We will now have a contract which is 17,200 and 17,600, because that is 17,400 is the middle level, right? So this 17,400 and 800 which we bought and sold earlier will be cancelled by selling and buying. We will do the reversal of the option which we have done and initiate a new contract of buying 17,200 call and selling a 17,600 call. Now if it falls further, then we will do that again. Okay. Say after it comes down to 17,400, let us say it moves back to 17,600. Okay. What you can do is that you can either keep quiet for some time, because you don't need to keep moving up, because to some extent anyway you're going to make profits, so you don't mind sacrificing a little bit on the profit side, so you don't need to keep moving it up and up. But whereas it starts falling a little more, we need to really look towards bringing it down further. See, normally what happens in Nifty in a bull market, generally 5.5% is the correction. Okay, 5.5% is the correction. Now where do we expect? So 18,100. So 5% approximately is 1,000. So we should expect this to stop somewhere around the 17,100. It may not go up to that. I'm saying that. In case if it goes down to that extent, it has to stop somewhere above 17,100, 200. So let us say it stops at 17,200 or 300 levels. From there, if it will start rallying, right? So when you do the transaction, first of all, look for some correction from the top of 3%, 2%, 3% from the top. From there, if you start doing it, from an investment point of view, the amount of rollover that you need to do on the downside will be quite limited. So this is not based on any no indicators or anything like that. The general assumption about this market. Suppose if it moves down by, start doing it when it starts falling by 3% or so. Now already 500, 600 points from the top it has come down, right? 17,600 is around 3% fall from there. So if you start doing it, maximum it could be another 200, 300 points. It can go lower. And there you can probably make one rollover at the lower side and then leave it also. Okay. So this is how you should do it. And next month, let us say you made a good amount of profit, then you can continue to think about whether you should carry forward that particular thing or wait for some dip and do that. So that will depend on how we view the situation at that point of time. The call option spread that we are talking about, it is not it is not a fixed thing. That's why I'm saying the innovativeness of the trader comes with a clear understanding of the delta and some of the option Greeks. You will be able to fix that spread. Why I have illustrated that this particular place is just on an illustration. Now the reason I am saying 17,400, 17,800 is, so let us say we are 17,600. It is equidistant. So most of the parameters of other option characteristics almost cancel each other, and so we are only with this 17,400 and 17,800 levels. Okay, now whether why and also whether it need not be 17,5 and 17,9, 300 points. Yes, it's still possible. It's still possible. Okay, so the spread of this is something which I would leave it to the individual person is concerned. But minimum I would like to keep 200 this spread, which is 400 point spread. But the I would like to maintain the equilibrium. So this is not 17,600. So I'm keeping, let us say, 300 points, 17,300, 17,300 and 17,900. Okay, so I can keep 17,300, 17,900 also. Okay, so it will all depend on how exactly the cash market investment, because you always compare yourself with what is the investment that I'm going to put in the cash market. So if I'm going to keep it here 17,300, 900, and I'm paying 300 rupees option premium, approximately I'm saying, into 50 is 15,000 per contract, and 17,900 I'm paying 17,000 for this one, so 32,000 rupees. And the delta could be something like, the delta could become 0.3. Delta could become 0.3, which means for every 100 rupees it will move by this price movement will move by 30 rupees. So I will have, for one contract size, I will move by 1,500 rupees. So for one contract size of this, I will move this by 1,500 rupees. So it will all now depend. Suppose 1,500 rupees I have to move, means in cash market. Suppose if I invest 15 shares, okay, for 100 rupees, I have to invest on 15 shares. 15 shares could be like 3 lakh rupees, like 3 lakh rupees. So compared to 3 lakh rupees, I am only investing 32,000 rupees here. 32,000 rupees here, and I will keep moving it lower. Now the biggest advantage for me in doing this is, if I keep moving it lower, okay, then at some stage the rally will come. Okay, when the rally comes, I will make more money than what probably I would have made in terms of the cash market investment, because here I will get much more profit up to certain amount of climb, which I will show you to in future illustration. I've already highlighted it here. So I'm more worried about only in the downside, so which I will keep moving it on the downside. But generally the Nifty has to rally, right, because it will make some positive value over a period of time. So that time, if I keep this, then the amount of money that I'm going to make on this investment is going to be much more than equivalent amount of money that I would invest in cash market. So that is the biggest advantage. We should probably at this point of time, what we should do is that today we are talking about, let us say you have to make a note of this particular price. So for every movement on a particular day, what if I had cancelled and booked? Okay, so you don't need to do it on an everyday basis, but you can just do it when the price exceeds by 200 points or so. Then in that case, you just roll it down and see what is it that I would have incurred. Okay, then in that case, from there, at the end of this month, okay, you will know what is the profit that you have made. So take today, April 11th, as an illustration, and whatever close that has happened, let us look at this particular value, which I will make a note of it today, and probably in coming days, we will illustrate to you how probably this will, or any past illustrations if I have, I will show it to you in future. Right now I don't have this, because you have to go through all the previous prices to jot it down, right? So do you mean we are net buyer of spread? Yes, we are net buyer of spread, call option, this one, we are net buyer of spread. See, what do you mean, what happens if the market drops 2,000 points like last month? If it's on single day 2,000 points, you are meaning? No. If you are meaning that 2,000 points fall, but 2,000 points fall, let us say you are at every 200 points fall, 200 points fall, 200 points fall, you are rolling it down. You are rolling it down. Okay. Now the question comes that, let me say you are only rolling it down. Okay. There is no upward movement at all. Okay. you are not getting that over in that particular month alone, right? So that is most important. Okay. So what happened last month? I will keep to the same point. Theoretically speaking, let us say you were at 18,000. Okay. So at some stage it came down to 16,000. Now from 16,000 it rolled back to let us say 18,000. Rolled back to 18,000. What would have happened? You invested when the market was 18,000, correct? Now the entire concept is that if it comes back to 18,000, if you should keep rolling it out both on the downside as well as the upside, as well as on the downside and the upside. You should not make a loss. You should not make a loss, right? Now let me say one point that I will give it to you. Let us say you did from 18,000 to 16,000. Not that it dropped by 2,000 points on a single day. Over a period of so many days, it dropped down to 2,000 points, right? So every 200 points of that, you are making a rollover. I told you that for every 100 points, you will make a loss of 20 points in the spread that I gave you of the 400 point spread, which I told you, 17.4 and 17.8. So let me say now we for every 100 points, so that means you would have lost 400 points. You would have lost 400 points, correct? So in this case, when it dropped down, you would have lost something like a 400 points loss. Now you would also be at that point of time, and when it's 16,000, you would have been at 15.8 and 16.2, right? You would have been at 15.8 and 16.2. Final thing, and you would have lost for 2,000 points. For every 100 points, I told you it's going to be 0.20. So you should keep it like that. Then you would have lost 400 points, correct? 400 this one. You are at 15.8 and 16,200. Okay. So let us say the market started to climb. Market started to climb again, right? Let us say you would also roll this 15.8, 16.2 to some higher levels. Okay. Let me say it came down to 17,000. It came up to 17,000. There, I would have had a 16.8, 17.2. 16.8, 17.2. Now, since when it came back with 1,000 points, my loss would have become divided into 0.5, right? So I would have now, because I would have made a profit when it started climbing up, right? So 2,000 points is there. 2,000 points. Now, in this particular case, now 16.8 to 17.2, okay. So when the market start to rally, I would have paid 200 rupees premium anyway. That would have been there. So here I would have got 200 points. Okay. Now because the spread finally when the market closed above 17.2, I would have got 400 minus 200 points. So 200 points profit I would have got. Okay. Now the 200 points here I've already earned back, right? The 400 points I've already earned as 200 points here when it started to climb, right? So when I get a 200 point, I will just keep 17.2 itself. Okay, just blank, just leave it. 17.2, 16.8, 17.2. Even if the market closed at 17.4, the cash market I would have lost. But in this case, I would not have lost. Okay, so I think the concept is that if you go a little deep into that, then you will understand what I'm trying to say. Because if the market is on a climbing mode, then from the point that you have done, then you can even feel a little relaxed. If it starts coming down, you should keep rolling it down, and you should also roll it up to some extent to recover the loss, and then the balance is left to your ingenuity. Okay. As a net buyer, what will be the impact of time decay? In the case of a spread option, you will not have. That is the reason why I'm putting it. In the case of a spread option, mostly you will not have. Okay, because you are buying and selling almost of equidistant. Okay, so very negligible time decay. It will be there, but very negligible time decay. But the only case of an option buying, deep in the money option, that is why I said, no, when you go for an option buying, to replace a futures or to replace a cash market, if you are looking at deep in the money, you will suffer less. Even in a weekly option, you go for a 500 points straight away. For a 500 points, you will have a time decay of only 10 rupees for that entire week. You will have only for 10 rupees in that entire week. But if you are going for at the money, And if the market is stagnant and you are not removed it, you may even lose 150 rupees. So that is why I'm saying that whenever you want to use option, just don't try to use option just like that for this one. You have to use it both for risk mitigation, you have to use for capital reduction. At the same time, you should compromise a little bit on the time decay, or if you don't want to compromise on time decay, put in a case of a spread option and pay a little bit on the margin. So then calculate that whatever amount that you are paying. See what is the margin that you are paying. Even in the case of this one, exposure margin for one contract you are paying 17,000 rupees. Now if you are paying 10 rupees also as a time decay, okay, 10 into 50 is 500 rupees. So 500 rupees on 17,000 is more than 2%, 3% in a month. 2%, 3%. So why do you want to suffer that? So instead of keeping the money in the bank, better you pay the exposure margin itself. So that is where the calculation will come. And these things, definitely it will take some time to do that. But spread option is a very good concept. So either you go for deep in the money or you go for a spread option. We are a net buyer of spread. We said no. Do you mean to say we are a net buyer of spread? We are a net buyer of a spread. The impact of time decay is very minimal, I'm saying, because what is the time decay of spread? 17.4, 17.6 you're doing it, right? 17.4, 17.8. The difference is 400 points, and you're in the middle, 17,600. So it should be exactly 200 rupees for no time decay, but you may pay 210 rupees. So that 10 rupees is the time decay. Okay. If you want, you can make an adjustment of the time decay. Probably you can, instead of 17.8, you can make it a 17.7. Then you will reduce the entire time decay also. Completely you can reduce the time decay also. So that is one chance. Probably you can try that also. Today, I think we have exceeded the time, so unfortunately we are not in a position to do the simulation just now and show. But what I will do for you is that, let us say today 11th we have illustrated this concept. We will note down all these prices. So on 27, by 27, the next 2 weeks, after 2 weeks we will have a session. We will see how these prices have worked. Okay, what rollover if you had done, what would have been the P&L, which will show with the exact prices around the probably around the 27th time. Okay, but what we will do is that normally we will not keep it till 27th. So 21st, 22nd, we will remove this and roll it over to the next month. I told you 1 week before the expiry of this month, then we will roll it over to the next month to avoid certain problems, which is like a sudden crash and all. Okay, thanks very much for your questions and participation. We are very much enthused by your questions, and definitely know those who want to ask more questions on this. Once we do the simulation and show the effect of the rollover of the option, kindly please join and ask all your questions. It will be very helpful, and probably instead of cash market, you can please come and invest through us in all these things. Thank you very much.